these multifamily syndications are illiquid. You can't get out. Like you said, they're typically, 5-year deals, and sometimes you can get out earlier.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. Today we are joined by Darin Batchelder. Darin has a diverse background as a GP in over 1,200 multifamily units, 200 RV units, and is also an LP in over 35 properties. He's gone full cycle as a GP on a number of multifamily properties in the space. Darin has also been in the whole loan trading business for the past 20 years and responsible for trading in excess of $4 billion in loan sales. He's a business owner of TZK Capital since 2007, which is focused on trading high credit, quality performing real estate loan portfolios between banks to include residential, multifamily, and commercial real estate loans. Darin also achieved his CPA status with Price Waterhouse, has a BS in accounting from University of Rhode Island. Darin, welcome to the show.
Dave, I appreciate you coming out. Having me on, my man. This is going to be fun. I'm looking forward to it.
Yeah, you bet. Always great to connect. Enjoy the discussion. So let's start with telling the audience a little bit about your journey and how did things start for you to get into the space.
Sure. So like a lot of people, I was kind of groomed in the get good grades, go to a good college, get good grades, get a good job, climb the corporate ladder. And I was hungry, man. I started out as a CPA with Price Waterhouse, and every job I had, I was always trying to, be the best and get the raise and get the recognition and all that. But it wasn't until I ended up getting, it was 2002. So I did CPA work. I did international audit for PepsiCo. I was in software sales, and then I was trading large loan portfolios. That started in 2002 for a large bank, ABN AMRO. I was on their mortgage capital markets trading desk in South Florida, and trading large loan portfolios between anywhere from 5 million to 100 million plus, and that really kind of changed my mindset in terms of doing institutional loan trading. And I had a lot of bank presidents and a lot of chief lending officers say that they loved multifamily loans. They loved them because they performed very well in their portfolio, both in good times and in bad times. And the way they explained it was everybody needs to live somewhere. So, when people are hurting, they're going to cut back on entertainment, but they're going to pay for food and they're going to pay for shelter. And so that's kind of how I got into multifamily, but it took me a long time. I kept just playing the corporate game and putting money aside and putting it into the stock market. And then finally, I'm 52 now, but I was probably 47 when I finally said, you know what, I'm going to start going out and buying some real estate.
Mm-hmm. No, that's awesome. Did you have a particular, light bulb moment or something that really, got you out of the, the passive seat and said, hey, I got to take action?
A few things. One was, you hear a lot that, 90% of millionaires are created through real estate. And so I had heard that over and over, but I just didn't do anything. In addition to that, I kind of heard somebody speak one time, and they were talking about the lighting people and the audiovisual people working in these, let's say gurus or big conferences that are motivational speakers. And somebody was saying, these people are there day in and day out, and they hear the message. They're there for their job, but they don't act on it, And I was like, you know what? I've heard this for years that multifamily is a strong asset class, but I just hadn't done anything. I'm going to do something about it. And so I went out and I was scared. And I bought a duplex, and then I started scaling up from there. And then I went from a duplex to 76 units, and now I've invested in over 9,000 units.
Yeah, wow, that's awesome. I know it's interesting. Everyone has a particular story, right, of how they got into it. What was that last straw moment, right, that really kind of drove you into something. Sometimes it's fear, right? Sometimes it's ambition. But it's interesting. And so, what would you say you've learned since transitioning into real estate as an LP as well as a GP?
Number one, I wish I had started a lot earlier. It just has massive wealth building opportunities being part of the multifamily space. But the other thing I would say is that, in addition to building wealth, it's really expanded mindset. You can't even understand where you will be in a year or 2 or 3 or 5 until you do the first thing. So you make your first investment. That's all you can think about. But then once you do that, new doors open, new relationships are made, and you don't even know what would happen. Like when I bought our first duplex, I had no idea that I would start a podcast, that I'd be invested in over 9,000 units, that I'd be an LP and a GP, I'd write a book, I'd be on YouTube. Like I had no idea. But you start learning that it's not just about you and your family. You can have impact on so many more people. And that's fantastic.
Yeah, totally agree with that, Darin. And I know we share the same ethos there, is the creating impact for other people and really, moving away from the volatility of the Wall Street, right? And it's also about having control, right? Because in that model, all you do is you wake up in the morning and you just hope that the markets are going up.
Right.
And that's really all you can do. Unlike, having hard assets. And as you pointed out, and, rightfully so, especially as we record this, we're kind of moving into 2023, right? With a recession looming, if we're not already in one, right? But as part of Maslow's hierarchy, people need food, people need shelter. So they're going to be cutting back on a lot of things, but you do need that place to live. So, there's risk in every asset class. But, how are you thinking about approaching 2023 with your current assets that are in place, as well as, potentially new ones?
So I'll say a few things there. One is that, I asked a lot of syndicators, like, what should I expect going into a recession as I got into this space? And, people told me, look, you probably have the bottom 20% of tenants in A's flow down to the B's, bottom 20% of B's flow down to the C's. And so I kind of had that in my mind. Well, then COVID happened. And that was something that nobody could plan for. Right. And being in, managing assets, cash flowing assets, where you're looking on TV and they're saying, you don't pay your rent. And I'm like, holy cow, like, how are we going to pay the mortgage if everybody doesn't pay their rent? Yeah. But what I found was every month we were cash flow positive. So we definitely had people that were slow paying, and we definitely had people that were, just milking the system and weren't paying. Then there were others that were rightfully so. They were negatively impacted by COVID, and they didn't have the cash to pay. But there were enough tenants that looked at it like, look, I'm going to pay for food and I'm going to pay for my rent. And we were cash flow positive all the way through. And then I couldn't believe that it performed so well. And I said to myself, you know what? Even if a recession comes, if we can make it through COVID, then we can make it through anything.
Yeah, 100%. There's an interesting statistic I think a lot of people haven't heard before, but in 2008, right, during that downturn, the default rate on multifamily was less than 1%. So, it really drives home the point that we're trying to make, right? Is that, people just need a place to live. So even in difficult times and everything, you're going to cut back on going to the restaurants. You're going to cut back on travel, maybe taking that vacation, things like that. But I mean, unless you're going to move back in with your parents into their basement or something, there's really not that many options.
To your point, I was at a conference and there was somebody from Fannie Mae that was at the conference, and they showed a graph, and traditionally over many years, their 90-day delinquency was like 25 basis points. And Fannie and Freddie are the largest lenders in the multifamily space. So they have data, more data than anybody on the metrics and how these assets perform in up cycles and down cycles. And then in the 2008 to 2000, the Great Recession, 90-day delinquency went up, but it was still less than 1% delinquency. And I'm like, so when I tell people about, risk mitigation, I'm like, look, the lead syndicator is going to underwrite this. The property management company is going to underwrite it. The broker is going to underwrite it. The broker is maybe going to use some inflated numbers. And then the lender has to approve it. And I say to my investors, like, look, if the lender approves the LTV that you were underwriting, especially if it's the agencies and they have all of that data nationally, that's just another, check mark that, what, this is a strong performing asset, because they are looking at the performance of the asset, not you as the borrower.
Yes, such a great point, and you've got such good insight, right, coming from that lending space to be able to kind of look at that. But yeah, it's further validation, right? And the bank is conservative as you get. So,
Absolutely.
that definitely strengthens the case. And in addition to, the default rate that we were talking about, the other thing that ties into this, right, is, and I know you've had assets as well, that, we're focusing on markets that have high job growth, have high population growth. They also have diversity in industries and different sectors that are there.
Right.
And that's really outpacing the norm in the US, right? So I think that even adds further protection.
Absolutely. If you're in a growth market, and again, point is to COVID, we were in the DFW market. I live in the DFW market, and Texas is a very strong growth state. And, like I mentioned, you couldn't evict people, but there were some people that would skip out in the middle of the night, so maybe they were, 8 months delinquent, and they just decided to go live with their, brother or sister or mother or dad. And so in the middle of the night, they leave. Well, we had a line of people that wanted to move in. We were full. And that just, if you're in a market where population is leaving, it may be much more difficult to fill that vacant space.
Yeah.
But in a growth market where there's new jobs, new companies coming, new income, new population growth, it's competition for all these apartments.
Yeah. And what's your prerogative on Class A, Class B, Class C in a recession? What are you focusing on?
Yeah. So, I mean, I think that I've asked a lot of syndicators, because over the last 2-3 years, a lot of syndicators have kind of traded up. They've gone from, doing BC value add to doing B plus A value add. So one of the things that they say is, can make sense to me in the sense that, look, the people in the B and especially the C area, it's typically like 1/3 your income, is the qualification. Well, in A's, it's like 1/6. So there's a lot more cushion for somebody that's in an A property to be able to pay. In addition, they typically will have more savings where, somebody in a C property, will be paycheck to paycheck. Having said that, it all depends on the type of recession. I think it depends on, most recessions hurt different people differently. And COVID definitely hurt, the C class, properties. It hurt retail. It hurt restaurants and, bus drivers and just, lower income, blue collar type jobs. But, if we end up having a recession where there's a lot of high paying jobs that are impacted, it could very well, be very different, where people can't afford the A rents anymore and they have to, kind of move down to the Bs. I don't know. It depends on which industries and which jobs are the layoffs.
Yeah, good point. And what are you thinking also about the debt markets, right? I know, it's going to be tricky, right? For some people who have loan products that are coming due 2023, a lot of people have hit rate caps, but, the debt is definitely eating up a lot of profits right now.
Yeah, absolutely. So, you've got rising interest rates, and what I'm seeing a number of deals that I'm in is you've got lenders that are requiring you to have much, much higher interest cap reserves. So let's just say that you had a 311 and you had a 2-year cap on that floating rate debt. Well, after, when you're going to have to buy a new cap, you typically have to put money in reserves a year in advance. And some people are seeing the combination of their interest expense plus their escrow reserves go up by not 10 or 20%, but by like 3 times. So going from like $30,000 to $90,000 a month. So you better have the excess cash flow to do that. And so that will pose problems for certain properties having that excess cap. Now, just like we talked about the tenant's profile and who loses jobs in a recession, the characteristics of the lender is very important too, because in my experience, banks, they don't want to own the asset. They don't want to maintain the asset. They don't want to have to pay for the asset. They don't want a delinquent asset on their books that they have to talk to the board about. So I think banks are much more going to work with syndicators to have some kind of workout plan or extension. On the bridge loan side, it depends on the lender, what their requirements are. If there's certain bridge lenders that have a reputation for lend to own, and they're looking for the syndicator to mess up so they could take over the property, and those people are going to be in trouble. There's other bridge lenders that, maybe they have a big debt fund that they don't want to have a write down in one asset, because then all of a sudden their accountants may tell them they have to write down the other assets that they have on the books. So they're going to try to figure out a way to kick the can down the road. So it's going to be situational for sure.
Yeah, makes sense. So where do you think really the opportunities lie then for next year?
So I'm a big believer in the asset class, for the long term. I don't think it's a get in and get out type of play, so there's a lot of things that, I wish I had a crystal ball, right? I mean, the bond market is so huge. You just can't not, forecast. I know you could look at forward curves, but a lot of times they're not accurate. So, one instance, you could buy property today, right, where it pencils out and you have a higher debt instrument. And then all of a sudden we hit a recession, the Fed starts lowering rates go down, and you could refinance into lower debt, and you're looking pretty at that point, right? Potentially cap rates go down. On the flip side, you could end up having, inflation that continues to run. Well, if you have inflation that continues to run, then what's going to have a bigger impact? The top line, where rents are going to go up with inflation, or cap rates going up and negatively impacting the property valuation? What I would say is, I think that multifamily for the long term is still a great asset to buy, but I'm a big believer in giving yourself flexibility by having a longer term rate structure on the loan, so that you can ride out a period of volatility in the market, for real estate. Because like you said, every investment has risk, and pretty much every investment is cyclical. So, real estate will have its day where it's down. It's just a matter of whether the cash flow will be there to continue to make the mortgage payments until you get out the other side.
Yeah, so true. And, I think, one of the really top five, I would say, traits from ultra wealthy family offices and how they invest, they're investing for 25-year blocks of time, right? It's a very long horizon, even multiple cycles, right? So it really forces you to look at, not only your goals and priorities and how you're investing and everything, but also the fundamentals of a particular asset class, or, everything that's embodied by that. And unfortunately, I think, we live in a world where we're just so caught up in reactionary things, whether it's the media sensationalism, the sky is falling, the market is here. And ultimately, right, investing is very, it can be very emotional, right? So people want to make moves. They see something happen. They want to kind of trigger it. So it can actually be, beneficial to you that you can't sell the asset, right? And we are typically in these things for 5 years. So I always trying to remind investors that, you have to look at this at least from a 5-year perspective, right? And not, worry about the weekly, the monthly kind of gyrations.
Yeah, that's a great point. And if you think about, look, there were let's talk about COVID again. So in that 2-week time period, the stock market dove. I'm certain there were certain people that got scared and they sold. And then the stock market went up for the next year and a half. Now, 2022, it's been a bad year, but 2021 was a great year. And so, these multifamily syndications are illiquid. You can't get out. Like you said, they're typically, 5-year deals, and sometimes you can get out earlier, 3 years, and sometimes they could extend to 6 or 7. But the model is like a 5-year hold. And I'm pretty certain that there were limited partners in my deals that, if they could have had liquidity when COVID happened, they would have gotten out.
Yep.
They would have gotten out and sold because they were scared, because of emotions. And then a year later, we sold for a dramatic profit.
Yeah.
And they all benefited. But, there probably was some time where they were like, oh man, I wish I wasn't in this. But they couldn't see. It's not like a stock where, it's $100 and then all of a sudden it's 40. You can't see the valuation on a day-to-day basis. So it's easier to kind of ride that wave. Right. Valuations have gone down, but you don't know by how much.
Right. No, it's such a great example, really. And it's so relevant, right? It's all fresh in our minds as we kind of come off of that. So, and we learn the most, right? From times of, failures, times of, difficult times, right? Like, such as we had in the pandemic. So that learning lesson should be, foremost on our minds.
Absolutely. Absolutely. So my partner on my first syndication, Raj Gupta out of Chicago, I don't know if you know him, but he told me, hey, Darin, man, this business is all about problem solving. And, I just kind of thought it was, real estate's real estate, man. It's like, location, location, location. That's what everybody says, right? But
Yeah.
there really are a lot of different things that, people can do. So I was just talking to somebody, another syndicator, and we're talking about, how interest rates have gone up, and they had floating rate loan and their cap was, they were starting to have major increases in their interest rate cap. Well, they called their lender and said, is there anything we can do? And there was inherent value in the cap that they had. So the lender said, well, look, if you were to extend your cap for another year and increase the cap rate where it is, we can lower that reserve. And they were able to lower their monthly reserve by 50%.
Wow.
That's
awesome.
That's a massive saving. Now that's problem solving.
Right.
Right. They could have just sat on their hands, but they went out and they found a solution.
Yeah, that's perfect. And, that's why they call them real estate entrepreneurs, right? And that, as an entrepreneur, that's so well said, right? It's all about creating value, but also solving problems, because there's going to be a lot of, things to be fought in the trenches on a day-to-day, week-to-week basis, whether that's, from things that are happening in the market, things that are happening on site, with property management or supply chain issues, right, that we've had. But you definitely have to be scrappy, right, to make sure things work.
Yeah, absolutely. And that's why it's so important to do business with people that like, and trust. Because look, I'm a passive in a lot of deals, as well as being a GP in a number of deals. And I don't know the day-to-day battles that, the lead GPs are doing, but I know I'm investing with good people that are going to fight those battles and come up with those solutions.
Yeah. I used to have this saying in the Marine Corps that you really don't know the essence of someone until you get into combat, and then you actually really see their true colors come through.
Oh, I can imagine. Well, thank you for your service. And I've never been there, but I could imagine. I could imagine that it comes out during battle for sure.
Well, there's a lot of parallels, right? Because you're running a business, you're managing these multi-million-dollar assets, right? There's a lot at stake, and we have to be good stewards, right, of capital to our investors. And so, what are you going to do, right? How far are you going to go to solve those problems, to be creative, right, and make things happen? And you're right, investing with people like and trust, but also people who have experience, right? I'm always, as part of our due diligence, we're looking really deep at the managing principles and what is their background, right? What things have they been through? Some people haven't even been through a cycle, right? People who are newer to the game, and also that entrepreneurial drive of what you're going to do to make things happen, and how strong is your balance sheet, right, to make things right for people.
All those are great factors. I would add to that people's network. So are they people that if they're trying to solve a problem, if they can't do it in-house, do they have a big network that they can call other syndicators that will pick up the phone and tell them, look, I had that same thing happen to me on this property. Here's how I handled it. Well, in a matter of 5 minutes, that syndicator might have a solution. Where if they're too arrogant or too, siloed, that they're unwilling to ask for help and, seek advice from other people that have been through it, then they may pick the wrong avenue to go after.
Mm-hmm. Darin, do you have a particular wealth strategy that you're following right now personally?
I would say no, I don't.
Okay. How about in terms of your portfolio allocation? Do you have some type of, parameters, guidelines that you're trying to work within?
So I'm a guy like what's working for me, and so I had I was brought up in the kind of get good grades, go to college, get good grades, get a good job, put 10, 20% away. It's going to grow into this big nest egg. And it grew, but it didn't grow to the point that I thought it would over the years. And so when I started pulling money out of the stock market and investing it in real estate, I saw the power of leverage, so leverage of other people's money, leverage of other people's time using, property management companies to manage the assets, leverage of the loan, all of the profit goes back to the equity owners, not the lender, leverage of, and then the tax efficiency, so I have another business and I had been paying significant checks to the government every year in that business. And then all of a sudden now I'm a full-time real estate professional. So I have all this depreciation and it covers the income on my other business. That was a huge, huge multiplier. So I don't have a set strategy, a set allocation, but I have seen real estate investments produce, wealth growth significantly faster than just putting money in the stock market.
Yeah. I think it really comes down to two different things, right? It's capital preservation, number one. How do you protect your wealth? And the more, high net worth individuals, right? More net worth that you actually have, you are focused on capital preservation first, right? And then in addition to that, it's also, multiplication of your assets and your growth, right? How can you do that? How can you kind of diversify that? So I know, that's kind of part of our strategy. Is the wealth strategy is really trying to have this, comprehensive approach to protect and grow your wealth, and really looking at it, comprehensively, right? Where you have asset protection layers, you have the right infrastructure in place, you have a capital warehouse, that's set up right with your infinite banking policy, and all of these different things that, as you kind of put them together, it just creates exponential results. And also, again, it performs in recessionary times, right? It performs in good markets, it performs in bad markets, right? So how can we, de-risk the volatility of, the markets, geopolitical risk, and some of these other things?
Well, I think it's an awesome service that you provide, that you can, not only talk to people, because most, including myself, most people are focused on their one little area, right? So I'm in kind of multifamily syndication, right? Real estate syndication, alternative asset, but it's multifamily. We have been have an RV park also, but where you're looking at multifaceted, providing different options based on the needs of different investors, and that's important, because typically, use the word financial advisor, is just going to put you in the stock market.
Yeah.
Because that's how they're compensated.
That's their agenda.
Yeah.
Yeah, exactly. Now, so talk to us a little bit about the RV parks, right? How is that? I know you have 200 units. How has that been performing for you, and what are you thinking about in terms of the future?
So we just closed on that. So, time will tell how it, performs. But here's my thinking in terms of why I got interested. One, my wife and I bought an RV back April 2022. We started traveling around, and I really like it. I like it for a number of different reasons. It's very social. It gives me access to different places that I wouldn't go otherwise. But in addition, as I started to travel this way, it started to I started to think about, look, residential real estate has gotten out of hand. It's so costly, and we're starting to see it now where, with interest rates going up, that people can't afford, to buy new homes. Multifamily has gotten significantly expensive. renting, a 1-bedroom or 2-bedroom apartment. 2-bedroom apartment could be what, $1,400 in certain places, and in the high cost market, it's $2,200. So these RV parks, a lot of during the pandemic, a ton of RVs were sold, and people need a place to go. In addition to that, you've got both sides of the spectrum. Millennials who don't necessarily want to buy a home, early on, they want to have the flexibility to move from city to city. Baby boomers who are selling their big mansions, and instead of going and buying other mansions, they're choosing to rent. And some of them are choosing to buy RVs and travel the country, and they need a place to go. In addition, you've got contract workers, construction workers, project workers, traveling nurses, all those types of people that may be on contract for 3 months or 6 months or 9 months. They don't want to sign a year lease, so those are the RV parks, I think, provide an alternative for all those different types of people, where it's lower cost. They can travel with their own RV, with their own stuff in it. They don't have to sign a year lease. They can go month to month. And then from a ownership perspective, I like it from a number of different reasons. One, like I said, it provides another rental opportunity that's lower cost. But two, if you buy a multifamily property, the unit structure is already there. 20% 3 bedrooms, 20% 1 bedroom, 60% 2 bedrooms. You can't really change that. So like I've seen certain properties, all of a sudden, everybody wants a 1 bedroom and we're full, right? We got plenty of 2 bedrooms, but they don't want it, or everybody wants a 3 bedroom and we don't have any. They're full. Well, with an RV park, you're basically, it's the land, it's the pads, the cement pads. And then there's a mix between daily, weekly, and monthly. Well, it's the same pad. Okay. They just have daily rate is higher than a weekly rate, which is higher than a monthly rate. But you can change that allocation on the fly. Okay. So you might allocate 80% to monthly. Well, if all of a sudden you see you're getting a lot of weeklies, you can shift that to be only 70% or 60% and get higher margin. And you can do that on the fly. In addition, you could raise rents immediately versus with multifamily, you have to wait a year for that tenant to go through their lease. So just like self-storage, you could buy a self-storage facility and raise $5 on all the units immediately. Well, on an RV park, if you see that the market has gone up, you don't have to wait. You can raise that by $5 or $10 across the board. So I like that when we're in an inflationary environment, it provides you the flexibility to raise rates to stay ahead of inflation.
Yeah, and how about from a depreciation standpoint? Are you able to depreciate much on a park?
So you're not going to get the depreciation. I mean, depreciation is that I'm assuming that you're talking about like bonus depreciation.
Bonus depreciation, yeah.
So bonus depreciation is going to be made up of all the things that have a shorter life, right? So the appliances and the carpeting and, all the flooring and all that type of stuff. Well, you don't really have a lot of that. Most of you have land, you have cement pads, which are more permanent. And then you have a few amenity buildings. You have the office building, so there's some, places for showers and bathrooms and stuff, but you're not going to get the depreciation that you're going to get in a multifamily.
Makes sense. Yeah. I know that you still get them on mobile home parks, right? There's still some percentage, that you would get, but yeah, definitely not as much as a mobile home park or a multifamily property. Yeah.
Right.
So, Darin, if you could give just one piece of advice to listeners about how they could really accelerate their wealth, whether that be through real estate or anything that you've learned, what would it be?
I'd say buy real estate. Buy cash flowing Okay. So it has to cash flow, right? So some people will look at, okay, I'm going to buy a single family house. Well, if the rent doesn't cover your mortgage and insurance and property taxes and all that, well, then it's not a cash flowing property. Buy a cash flowing investment property, and it is amazing because it will provide you cash flow and appreciation while you sleep.
Excellent. Darin, really appreciate you coming on the show today. It's always great connecting with you, and I know the audience is really going to enjoy the discussion, learn a lot as well. If people want to connect with you, learn more, what's the best place to do so?
Best place is our website, darinbatchelder.com. So it's DARINBATCHELDER.com.
Awesome. Thanks again, Darin. Appreciate it.
Absolutely. Thanks for having me on, brother.
You bet.